Thank you. Good morning. This is the New York City Fire Pension Fund Investment Meeting. We are at One Battery Plaza on the 9th floor in the conference room. We have some attendees participating via WebEx. Today is November 6, 2023. It is 10:06 a.m. Mr. Dunn, will you please start the roll call?
Certainly. Thank you, Commissioner. For Mayor Adams.
Ryan Berge representing Mayor Eric Adams present.
Okay. For Controller Land.
Allison Hirsch representing Controller Brad Lander.
John Dorset, alternate designee for Control, Brad Lander.
And for Commissioner of Finance, Nybrook.
Kevin Liu.
Okay. And for the UFA, Mr. Andrew Ansbro.
Bobby Eustace with Andrew Andrews proxy.
And Mr. Eustace.
Present.
And Mr. Christopher Viola.
Present.
Okay. Mr. Eric Bischoff.
Good morning, President.
And Mr. John Young. Mr. John Young is present. For the UFOA, Mr. Joseph Camastro. Mr. Liam Guilfoyle.
Here.
Mr. Sean Michael. Temporarily, Mr. Camastro has Mr. Michael's proxy. Mr. Michaels will be right back in the room momentarily. And for Commissioner Laura Kavanaugh,
Lizette Kristoff.
we have a quorum.
Great, thank you. We're going to start with the public agenda and I will turn it over to the Controller's office.
All right, so good morning, everyone. We have just two small items in the public session. The first is just a welcome and some remarks from Steve Meyer, the Chief Investment Officer. And then we're going to have a quick discussion about the strategic asset allocation, which would be a continuation of last month's meeting. And we can take the appropriate actions once we hear from our consultant, NEPC, and from the Bureau of Asset Management. So with that, Steve, we'll turn it over to you for some remarks before we start.
Great. Yeah, thanks, John. So maybe just to jump right into the strategic asset allocation, I'm going to turn over to Doug Mosley from NEPC in a moment, but there's actually been a lot of good work that's been done in terms of assessing a strategic asset allocation mix. And just a couple of comments. I know we met 3 weeks ago, and we talked about 3-week performance and 1-month returns and 4-month returns and returns year to date, both fiscal and calendar year. Those are really not important. What we really should be focused on is the strategic asset allocation that will drive long-term returns over time to meet those long-term liabilities that we have for the PAN and those promises. So with that, I'm going to turn over to Doug to kind of take us through his most recent slide deck on strategic asset allocation.
I don't know if someone can pull it up on the screen or not, if everyone has it open. At the last meeting, we went through the presentation and recap discussion from September, and there was some requests from trustees to look at a few slight variations, alternatives. And so if you open the NEPC presentation, and I'll just go ahead and cut to page 4. And there's a table there that has, again, the current policy. Wait till, I don't know if him or somebody can pull it up. They're not on screen. Hopefully everyone's got it. It has the current policy, which is unchanged through these discussions. And then we put together Mix A, which we left in place from last discussion, which was our initial recommendation. So starting with Mix B, C, D, and E, those 4, we put together variations that first looked at an allocation of 12% to private equity. And that was something the board seemed very comfortable with. His current allocation is 8. I believe we're hovering closer to 9 and 9, a little over 9. So we're closer to 10 already. So I think the group consensus was it might make sense to examine the 12% allocation. There was also some question about total equity ratio and getting that back up closer to 50%, as Mix A had recommended getting it down to 47. So the other mixes all go back towards 50, 51, 53. And then the last area to examine that we looked at was the hedge fund allocation. And we had recommended increasing it to 6, but I think the board wanted to look at either staying the same or lowering it. Now, I would say that with most asset classes that we are comfortable, we think if you're going to have exposure, you probably want to do at least 3%. So we looked at going back to 5 in mix B, and then at mix C, hedge funds dropped to 4. And then the last two mixes, D and E, where you have a higher public equity ratio and that private equity stays at 12%, we eliminated the hedge fund allocation. And when you do that, we actually tweaked up the real estate by 1% because we think, again, hedge funds are a diversifier. They ultimately give you exposure to different types of active strategies, but they also give you exposure to some equity beta and some fixed income beta. So we really spread that back into the fixed income area. You can see in mix D, we increased the corporate bond allocation by 1%, real estate by 1%, and then the rest flowed up to the large cap and non-US equities as you eliminate the hedge fund allocation. The effect at the bottom, just of looking at these, is you do get a higher return with a higher expected return that's closer to 7% for the 10-year time horizon, but over the 30-year time. Yeah, sure. Okay. I don't know, Liam's on here.
No, I'm on. I just can't, for some reason, the mix is not up on my, I can't see it in my view.
Do you have the Adobe from Convene though?
No, I don't.
Bear with us, Liam. Oh, I think some. Thank you, Alex. Great. Sorry about that, Liam. And the rest of the trustees are on the phone.
Not,
All right.
no problem, man. I appreciate it.
Yeah, so these mixes, I think, again, small adjustments, higher equity ratio, decreasing exposure to hedge funds, and really going with the 12% private equity allocation for mixes B, C, D, and E. I think I would say I'm very comfortable with the idea, if you're already almost to 10, to going to 12, because that'll impact your plan and pacing activity for the next several years. I do think it's not that it's close to in line with your peers. I think depending on which peer universe you look at, more of the large public funds over 10 billion have north of 10% on private equity. And I think it's been a very successful program. And as I was talking about a little bit with Steve before the meeting, because FIRE is slightly less well-funded than some of the other systems, having, that extra higher return category be a little bit overweight relative to some of the other New York City systems, I think makes sense. It really comes down to a conversation about whether the board is comfortable keeping hedge funds or whether you want to move to eliminate them or reduce them to 4. And then, you can always consider eliminating them at a point in the future. I think a big
Doug,
factor. Yeah, go ahead.
Doug, just out of curiosity, bro, from the studying that I've done on this, I'm being told and reading that doing 3% or less, you might as well not be in hedge funds. Is that correct?
I agree with that sentiment. And it's really, Liam, it's a little bit of a subjective decision. There's no research to point that doesn't make sense, but your time at this table, your governance time is valuable. And if you're not as comfortable with hedge funds or want to emphasize other areas, then, keeping a small allocation where you still have to spend time talking about managers, reviewing the performance reporting, termination, higher recommendations. It doesn't make much sense.
Just for me, it really boils down to this. In some of our conversations, it seems like our hedge fund portfolio isn't 100% a hedge. it kind of goes up and down like the long shorts seem to go up and down with the market. So if we're going to be in hedge funds, does it make sense to take a look at them to see if they are an actual hedge to the rest of the portfolio? Because if they're not, then I wouldn't have a problem with getting out of hedge funds. But if you believe that it's going to take some of the risk that we take in other areas of investment off the table to stay in them, that's what I'm trying to understand. Is our hedge fund portfolio taking risk off the table, or is it running along with the rest of our portfolio at this point?
So relative to stocks and bonds, which are your primary allocation, where much of your money is, hedge funds are counter-cyclical. 2022, I think, was a good example where your hedge fund portfolio in particular is a little bit credit light because you have the OFI portfolio and you have high yield as a separate allocation. You had the trend followers in there and some of the global macro managers. I think many of them were well positioned to take advantage of the bond sell-off that happened as the Fed and other central banks globally started to raise rates. We can go back and show you kind of what your experience has been with, again, the primary measures are risk and return, but the correlation. And, I know from looking at the reporting from Axia that the FIRE portfolio has a very low beta to equities, and it also has a pretty low exposure or correlation with bonds. And that's what we like about that structure. And we do think that there will continue to be volatility in stocks and bonds. The volatility does create opportunities for any of the global macro managers to look at discrete trades that can make money even if markets are selling off. And that's really what they do and they focus on.
No, I appreciate that, Doug. I'll let you continue.
Actually, Doug, if I can just add, so I do think that irrespective of where we come out on the allocation, assuming it's something above zero, should probably take a closer look. You mentioned earlier about beta exposure and some of the hedge fund positioning. We could be more tactical, perhaps more strategic within the context of the overall portfolio. So I think, Neil and his team have done a great job developing a very balanced portfolio of hedge funds. Question is, maybe we should be thinking more about how it relates to other aspects of the portfolio from an equity standpoint, private and public. And that just means maybe we can, if there's a change, something above, I agree with your assessment, 3% somewhere, 3 or 4% seems to make sense. That we can go through and review the portfolios, the individual holdings, make a determination of what we think will be a better fit for the portfolio longer term.
So can I make an observation? Which is that, treasuries at, call it anything in the double digits, right? 10 and a half. The rate at which we go through this exercise of an asset allocation, while I think that rates are going to not be zero, and let me preface this that I'm not an economist. I don't think rates are going to go back down to zero anytime soon. I think they're going to hover likely in the 4, give or take 50 basis points either way for quite some time. Does it make sense to eliminate the hedge fund component and effectively put more money into treasuries if this is a policy we're adopting for the long term? And I think about that in the sense of we're going to adopt an asset allocation. It should be a long-term, hopefully a long-term allocation with certain tweaks in the meantime. So I'm just wondering if that makes a lot of sense, if that's the avenue to go into. I know it's like the T-bill and chill thing is like where the industry is going for retail investors, but we're a very large public pension. I just don't know in the long term if that much in bonds would make that much sense, considering that not only are we trying to preserve capital, we're trying to increase the corpus of its fund too over the long term. And we still have payouts, by the way.
I would build on what you said and say, without specifically saying just U.S. Treasuries, that higher interest rates or more normalized interest rates, as I think I would characterize them, have created an opportunity for public pension funds to de-risk a bit. And that means adding more to a mix of bonds. And I know treasuries, we talked about them being around 5%. I Remember, with corporate bonds, we get 5+. We usually get 5 plus 100 or 150 basis points. With high yield, we get the 5 plus, 4. And so we've got a lot of opportunities now where the floor has risen on bonds to get us closer to our 7% target, 6.75. And even with some of the categories now hovering right around 7, when you factor in that spread or that yield premium for corporate credit risk, whether it's high yield or investment grade. So I think the private markets that you have in place, real estate, private equity, that's always a long-term strategic investment. Those are getting higher returns. And with higher returns from bonds, we can definitely adjust the mix and reduce the risk. Here, we're making some tweaks to do both things. Some of these are risk reducers and some of these are adding projected risk. And we've talked a lot about that with private markets, how the volatility that we model is different than what you experience with a diversified portfolio.
So does it make sense, if the real question that we're pondering is whether or not we want to be in hedge funds or not in hedge funds and how that affects the rest of the portfolio? Does it make sense to kind of narrow it down? We have 5 options here to 2 options that we can really look at to make a determination on. One with a 0 hedge fund allocation, one with a positive, not a positive, but an allocation to hedge funds, so we can really hone in on the differences between the 2 portfolios
Yes.
and perhaps take the 30 days to the next meeting to kind of drill down into 2 of these 5 options.
Yeah,
I think that makes some sense. Brian, I see that you are itching to say something, so I'll turn it over to you.
Yes, I'm itching to say something. So the discussion we're having right now seems based on, kind of abstract characteristics of asset classes. I was wondering if there would be transaction costs or sunk costs to have a sudden transition from the 5% funds to 0. Recognizing that while they are probably more liquid than private equity fund stakes, it's still not the easiest thing in the world to just sell off a hedge fund stake. Whether there are hidden costs that are not taken into account in this type of exercise, if we were to make that change.
So let me just say, nothing we ever do is slow. I mean, nothing we ever do is fast. So, so the swiftness that we move this portfolio is as swift as an oil tanker goes from, makes a 180-degree turn. It's not going to be fast.
Not the Exxon Valdez. We don't
Yeah.
want to.
Yeah, but so with that said, though, I'll turn it over to Steve to talk about the cost piece. I just want to caution folks, we're not just going to flip the switch and tomorrow you'd have a new allocation. That's really the point. Is it would take
Yeah,
some
no, I understand that, but even so, you might be in a situation where you're stressed to sell.
That's an excellent observation. You're absolutely right. Moving from 4% tips to 0 and tips is a lot easier than moving from 5% hedge funds to 0. So maybe there's an iterative step where take hedge funds down from 5 to 4, maybe you maintain a little bit more in treasuries. In Doug's mix B, other than those 2 tweaks, I think is quite on the money. And Doug, you talked about the increased allocation, investment grade credit, high yield credit, private credit. First 2 of which are fixed typically, and private more in the floating space. So I think that covers us well in terms of having enough balance in both exposure short and long duration assets. And this way we can reassess, again, part of the process would be to reassess the hedge fund holdings. Right now you have 20. How do they relate to the rest of the portfolio? So right now the discussion is strategic asset allocation, but Doug, we should probably sit down, depending upon what the trustees decide, is to go through our holdings in hedge funds to see what makes sense within that mix. If there is some level of maintaining.
Yeah, to go back to John Dorsey's point, it seems like we want to focus on mix C and D, right? Mix C is we're lowering hedge funds to 4, still keeping it in the portfolio for now. And mix D would be kind of the natural step if you did want to 0. And I do think it would be helpful, back to Liam's questioning, to give you a little more detail on the characteristics of your hedge fund portfolio and how it relates to, our assumptions. Give you a risk return chart might be helpful so you can see where on the risk return scatter chart our assumptions are versus what you've achieved, say, in the last 7 years or 5 years both. So you can see those relationships, and we'll talk more about the beta, and then the BAM team and Axia can talk a little bit about the portfolio and how they view it as countercyclical. Certainly you can look at the monthly performance history of the hedge fund portfolio and see when there's sell-offs and that portfolio was either flat or maybe even positive. And that, I think I'm thinking in particular, the first half of last year, 2022.
The next question too would be, the goal, it seems at this point, it's somewhat lessening hedge funds. If not, we're not looking to go to 5 to 0, but somewhat lessening. We feel like we built our own hedge inside the whole portfolio. Other question is, like, again, we're increasing stuff like private debt and US high yield. I know fixed is now fashionable, but couldn't there be a greater default rate, greater beta based on the fact that they're now being squeezed with the higher rates inside that space? Like, we're assuming increasing there in that area. Is that automatically advisable?
I think it is because we have active managers. We've gone through a very detailed selection process. We have active managers in the high yield and the private credit space. Doing all credit or private credit is active. So I do think we hire managers. We hope we can work through those situations if there are defaults. I wouldn't not allocate because of an expectation there might be an increase in defaults if we go into a mild recession in that year. Again, I think being strategic in the long term, I actually think high yield has a bigger role in the portfolio. It's got half the duration exposed, say, investment grade corporates, and wider spread that actually improve these portfolio.
Yeah, and if we could I'll just make one point to add to that. Our assumptions do assume a higher default experience. And if you go to page 13, Allison, just to give you how our assumptions developed, right? So you're in that same deck, just page 13. And it says fixed income at the top, building blocks. Very good. So when you look at this page, I talk about our assumption all the time for high yield, which is the third from the left. It's 7.2 right now. And what goes into that is, remember, I just talked in reference a few minutes ago, the idea of a yield premium, what you capture when you go from treasuries to corporate bonds, you're taking credit risk and you capture a credit spread. So the dark blue block there that goes from 0 to about 4.5, that is the government rate, right? The underpinning of that fixed income market. The credit spread is the next darkest blue that's right above that. And so as rates have risen, that dark blue bar, if you looked at our assumption a year ago, is now higher. The spreads have widened, so that's now higher, right? If you talk to a high yield bond manager right now, or we looked at any of your high yield portfolios, I think they're yielding about 9, maybe even 9.5. We're using 7.2 because as those two dark blue bars have increased, we've also observed that credit risk is increasing. The risk of default is increasing. So the line that's the block that's dark gray, that's below the 0 line, that's where we're taking a haircut for the increasing risk in the high yield market. So we're not just looking at the yield saying, hey, those bonds are yielding 9%. That's our assumption, it's 9%. We're saying, we're looking at the components and we're saying, here are the building blocks. Here's how each of them has changed, right? And the other ones, there are what we expect from a spread price change, meaning we actually expect them to rise a little bit further. And they're going to the market's going to say we're a little more jittery about high yield. But again, the assumption is you have I think 5 managers in place in high yield. We can scale those up over multiple quarters, maybe even take 12 months to scale to the new target, whatever makes sense. And that way we'll be legging into it. And I do think, we're talking about pending recession for a while here, but we are starting to see the cracks in different things that will impact corporate earnings and that default rate. And we do expect that they'll get more attractive. But we're already factoring in that.
The widening of credit spreads by 125 basis points and high yield on average is an example of the market cheapening up because there might be higher levels of defaults.
Yeah, like I'll give you my favorite example is at the peak of the financial crisis, so March of 2009. If you looked at the yield on a high yield bond mutual fund, it was close to 18 or 19% on many of them. That's not just one bond. That's 100, 200 bonds in a portfolio. So our assumption got up to 11.5, I think, for high yield, which was much higher than equity assumption. Because but you can tell we were assuming there would be more credit losses in the next, again, we don't think we can predict year to year, but looking at conditions, we raised that lower below the line bar, substantially to 4 or 5%, I think it was, and still got to an 11% attractive, assumption in the middle of that. That was when trustees were having conversations about, should we go to cash? And it was a very panicky moment for everyone who was an investor, regardless of how much experience you had or perspective. Right. So I guess we'll focus on mixes C and D and come back with really either just those two with some more elaboration or data points on the hedge fund portfolio. It sounds like that's what the board would like for December. I know, Liam, you're not in the room, but does anyone else want to comment? Bobby or?
All right, so are we good on, I believe it's C and D? Are those the two that we're,
John, in all honesty, brother, if it's possible, I'd like to set up a couple of meetings with Sean, Joe, anybody from the UFA between now and the next meeting and hammer this out a bit more. And I appreciate the work that's been done. I think we need to do more than just one meeting today and then talk about this next month. So Doug, if we could set up a couple meetings in between now and the next, really hammer down on the questions that I have and anybody else in the room. I think we need to do a little bit more work on it. I don't want to just pigeonhole until I get a good grasp on where we're going with this.
so can I just interject, Liam, and just say, no objection to the union side of the table having deliberations with consultants. As a courtesy, I would just ask that you let the city side know which two options after your first couple of meetings with NAPC are the ones that you are most that we should really be concentrating on our effort of looking through
John,
things.
John, not to cut you off, dude, but I'm going to let you know the dates that we get together with them because I'd like to hear your thoughts and Allison's thoughts and whoever else wants to be in. I just think we need to do this more than once a month.
Yeah, no objection.
And certainly we would share any materials put together. Thank you.
And can we also look at C, D, and E also, which give the increase in total equity? I know you guys are. Can we look at the E?
Sure.
Option? So
Sure.
going to zero, I'd say again.
Yeah, no, I think
Not knowing
if
how-
you're going to go to zero, the data will come together to discuss whether you're going to stay at 4, 5, or go to zero. And then if you go to zero, then you've got those different options.
Yeah, I'm in agreement with Liam. I think we need to look at all these options, not talk about them right now.
Yeah.
The time.
Yeah, and I also reflect that certainly the Bureau of Asset Management, we're working really closely with Doug and his team, and then you can see, you're right, plus pause and be thoughtful.
And we want you guys there.
Yeah.
Want to take away from the meeting right now. It's a lengthier conversation. So we'd
Yeah.
like to have another
Yep.
meeting to have now.
Yeah.
Okay, so with that, I believe that concludes the public agenda. And I would like to make a motion that we exit public session and enter it to executive session.
Second,
Sorry, Liam, you got beat to it.
that works.
That's the response time. Very good.
Any opposed? Hearing none, the motion carries. We are entering executive session. If someone could please stop the recording. Great, we have re-entered public session of the New York City Fire Pension Fund investment meeting. While we were in executive session, the board discussed various investment matters. We have nothing further on the public agenda, so I would welcome a motion to adjourn.
Motion, Liam Guilfoyle.
Second, Bobby Eustace.
All right, any opposed? Hearing none, the motion carries. We are adjourned. Thank you all.
The Lord's work.